Hi there, I'm Darren McDermott and you're watching Dukascopy TV for a brand new series with Ron Williams, Market Strategist at RWA. Today we are going to take a look at the markets and the current geopolitical situation. Ron, welcome.
Hi, it's a pleasure to be here, thank you.
So first of all, we're going to take a look at the Russian stock market, as Russian stocks were the worst performer of 2014. So what will you be closely watching out for in terms of this?
Well, just to build on what you just said, the Russian stock market has been the worst performing stock market across the board this year so far. And it has been a 20% drop, cliff drop in price terms. We can just see here on the right hand of the screen. And that has been anchored, of course, by the geopolitical situation in the Ukraine and what that means vis-a-vis Russia and sanctions that are now building up on politically. Now, from a chart perspective, it's a great way to get an idea of the mood of the market, but then also of the situation. And the stock market can sometimes provide a leading indication to this, even sometimes the headlines themselves. And so one of the big technical headlines is this critical 9-year zone that the market was testing some time ago. Now, we were revisiting multi-year lows, but the key message is actually this historical level in the market, which is very important. We've tested it several times in the past, and we really need to probably have a sustained confirmation beneath this level at around 1250 to 1200 to suggest to us that people in the market are reversing their positioning to the downside. The additional message I would highlight is if you look at the left-hand side of the screen, we have this measure of price value. The indicator is otherwise known as market profile. And what it does is it measures statistically the value zones or the strong or weak areas in the price chart. And we can see that just below this level here, there is a very weak price zone or weak price vacuum, which basically tells us that if the market does break down beneath this level, that it'll be a sharp drop. Technically, my projections are suggesting a move down to 1,000, which would be an additional 20% drop into a key psychological area.
Okay, and next up now, Ron, is oil. We're going to be taking a look at Brent crude and WTI. We have seen a sharp widening. So why is this?
Well, this has been the sharp widening here early this year, so another market reaction on the back of what's been happening on the ground geopolitically. One thing I will say just very quickly on the chart is for those who are interested in this chart, it's a relative value measure of Brent West Texas, two of the most widely traded oil contracts. And what it tends to show is during geopolitically sensitive times, Brent tends to serve as a premium over West Texas. So in other words, Brent tends to be more expensive over West Texas. And that's partly because of its proximity as a European contract to the Middle East and also to Russia in this particular context. What we see here is that during the 2011 Arab Spring, not so long ago, Brent did reach a record extreme against West Texas. So we see evidence of how this spread does react to geopolitical events. Of course, there are other demand and supply fundamental drivers, but in terms of a key exogenous event such as 2011 Arab Spring, we see evidence here. Now, since then, it has been quite a volatile range that the spread has been trading in, and so I've put a regression band on here so we can see statistically how the extremes can be measured. And just recently, early this year, as you mentioned on the onset, we had a big widening of the spread in favor of Brent up to around $8. If we were to push above 10, then that would suggest a favor back to a $10 to $20 premium just between these bands here, back to the old highs. So this is a risk to the upside on Brent further widening against West Texas.
All right, and moving on to our next chart, focusing on Brent crude. Now we are seeing Brent crude nears the end of a 4-year breakout pattern. So can you tell us a little bit more about the trends we're witnessing on this chart?
Well, this is allowing us to take a big picture look at the actual contract itself, Brent, which, as we just mentioned, is the more geopolitically centric oil market to be watching at this moment. And as we can see here, most kind of technicians will know this as a pretty important breakout pattern, and it is a 4-year breakout pattern, reaching the apex of that move. Now, psychologically, what this is telling us is that buyers and sellers in the market are in the middle of a tug of war. They're battling back and forward to try and decide a price value in market. And at the moment, that battle is going to reach to some kind of fruition at some point. So there should be a breakout of some point in the near future. Now, interestingly, if we look at a measure of volatility, Bollinger Bands, which I've overlaid there in the blue highlight, that shows that volatility is also at the lowest level it's been in 30 years. So one of the philosophies we believe in market analysis is that every action leads to a reaction, and so low volatility, we believe, is going to lead to a high volatility breakout at some point. My favor is to the upside, so a potential upside break on oil. And if we were to get some kind of confirmation to the upside, in price terms, I believe it would be perhaps to the old highs at around $130, with a potential spike risk to 150 if things really do get a little bit wild.
All right, and let's have a look at the final chart. Okay, so what are we seeing on this?
So the final chart is builds on the last one that we're looking at, and it's making the case, adding more credence to the case of a potential price spike in oil. So it's always a big headline, wondering,
exactly,
if we might see this type of a risk. But I'm trying to ground it in real terms. So in terms of oil spikes in history, the oil market experiences an oil spike, at least in terms of this chart, every year or so. It's a cyclical phenomenon, and we can see that every year or so oil will spike by about to 1 standard deviation. There you can see just the regression bands there, and I've highlighted in red, in the red arrows, at each of the peaks that we've seen over the past. Now what's critical on this chart is that right here, right now, we're at historical 22-year lows in this volatility measure. So again, it's an extreme, and it suggests a very interesting setup for a potential mean reversion to the upside. Now, one way that viewers could maybe play this is in the options market, where they could potentially hedge for upside mean reversion on volatility on oil, but also a potential spike in price terms on the oil market.
Ron, thank you very much.
Thank you very much.
Well, I hope you found Ron's advice very helpful, and he will be back for more interviews just like this one. Goodbye for now.